Okay, since this video is on rising interest rates, I have to start out by asking what's going on with the Feds? Are they trying to crash the economy by rising interest rates so fast? It sure seems like it. We all know about their good intentions, that they are trying to lower inflation, right? So consumer prices will then come down. So how long is this going to take though? They've managed to lower inflation from 9.3% to 6.3%, but it's taken a year and they still have a long way to go to get to their benchmark of 2%. It sure seems like they are hurting a lot of businesses, consumers, and employees in the process. And let's not forget everyone who wants to build, buy, or sell a home, or a rental property, or a commercial property, or for that matter, anyone who makes their living connected to real estate. They are all hurting. So, what is the Fed Chairman Jerome Powell's strategy here? It's blatantly simple. He's trying to slow down the economy by increasing the cost of credit, both for consumers and businesses. His thought is that this will lower demand for just about everything, which is the best tool in his arsenal for lowering prices on just about everything. But this is kind of like those ads for medications that promise amazing results, but then disclaim at the end, this could kill you, by the way. Seems like the Fed strategy also comes with the same warning for the economy. Oh, but this could kill you, by the way. So their strategy is wiping out the profit of many businesses and going to raise unemployment. Business Insider just wrote an article saying that the Fed's goal is actually to raise unemployment, maybe by lowering, knocking out 200,000 or more jobs. But this is really hurting people. You know, I have a client who bought a granite business 13 months ago and assumed an SBA loan at 4.75%. Now, after the ninth interest rate hike over the past year, this has raised his rate by 4.5%, and his loan is at 9.25% today. That's awful. This has put his income in the red. And making his life even worse, his accounts receivable financing, his inventory loans, and his business credit cards have also gone up by 4.5%. So he's had no choice but to lay off half of his staff, which have gone on unemployment. So it's obvious that if the Feds keep pushing interest rates up, sure, they're going to continue to lower inflation, but they're also going to break something like maybe the economy and also probably push us into a recession. Okay, so stick around. If you ever wondered exactly what is affected by the Fed's raising rates, I'm going to go over that. I'm also going to go over these questions. When the Feds raise short-term rates, does this automatically raise long-term rates? How are long-term rates determined and who sets these rates? How do rising interest rates affect commercial property values? And lastly, will commercial property rates continue to go up and will they come down sometime? Hi, I'm Terry Painter, the president of Apartment Loan Store since 1997, where we have over 40 multifamily loan programs to choose from. I'm also the author of this big 500-page plus book, best-selling book, I should add, the Encyclopedia of Commercial Real Estate Advice, which has everything from A to Z on the subject and some great stories from my clients' deals, which I promise makes this book a great read. Okay, so let's start out by answering the question, what is affected when the Feds change interest rates? When the Feds change short-term rates, this has an immediate impact on the federal funds rate, which is the rate banks pay when borrowing money from other banks and the Feds overnight. This also affects prime rate and the secure overnight financing rate known as the SOFR rate. We also call it the SOFR rate. All credit cards and most businesses are tied to the prime rate, and most adjustable rate mortgages and construction loans and temporary bridge loans are tied to either prime rate or the SOFR rate. So when the Feds raise short-term rates, does this immediately raise long-term rates? Well, most people certainly think so, but this is not exactly the case. You see, within a week or so after the Feds increase short-term rates, there is a trickle-up effect to long-term Treasury bond yields, which long-term mortgage rates are tied to. So when short-term rates go up, rates on older existing treasury bonds go down in value, which pushes new long-term treasury bonds up as investors scramble to buy them. And those are really hot when they're going up. Okay, so long-term mortgage rates are tied to these new rising bond rates and go up with them. So let's go to the next question. How are long-term commercial loan rates determined and who sets these rates? They all start out with a real-time treasury yield, which is the index, and then the lender adds to this a spread, which is based on what they want to earn on the loan. So the lender and the current treasury yield ultimately determines the rate for that day. Let's use Fannie Mae multifamily as an example. On December 19, 2021, the federal funds rate was near zero, keeping the 10-year treasury yield index very low at 1.37%. I wish we could go back and have such a low treasury yield now. Okay, but Fannie Mae then added to that index a spread of 2.20% for a total rate of 3.57%. Today, the federal funds rate has gone up to 4.8%, which has pushed the 10-year treasury yield up to 3.52%. And Fannie Mae and the lender together have added to this index a spread of 2.26% for an all-in rate of 5.78%. Okay, and so as treasury yields go up, I should add that most lenders also create a double whammy by raising the spread. Okay, it seems like they do this when they perceive there's going to be a higher risk, which of course, a higher rate does create a higher risk, but they're creating this. It seems like all lenders charge more when they think the risk is greater. It seems like they should do the opposite, as a higher rate is definitely going to increase the risk more than just about anything I could think of. It makes your payments higher. So how do rising rates affect commercial property values? When rates are low, a buyer can borrow more funds, and this enables sellers to get a higher price. Conversely, when rates are high, a buyer can borrow less, which brings prices down. It's really that simple. Are mortgage rates going to stay high and continue to go up in 2023? The answer, in my opinion, is yes and yes. This is because, as mentioned, rising rates is the Fed's biggest weapon in lowering inflation, which is still high right now, and they have a long way to go. And so I have to say that since the Great Recession of 2008, the Feds have also been buying large quantities of Treasury and mortgage-backed security-backed bonds. I mean, like over 80 billion a month, which artificially kept rates low for a long time. But keep in mind that inflation was almost not existent back all those years. And what they were really trying to do is just stimulate the economy. Well, now it seems like they're trying to de-stimulate the economy because they're doing exactly the opposite today. Okay, so they stopped buying all those treasury bonds exactly on March, I can't remember the exact date, but it was March in 2022, which, oh, by the way, just happens to coincide exactly with when rates started going up. And yes, buying those bonds was the same as printing money. But if there's a recession, I do believe that rates will definitely start coming down because they seem to always do that. I sure enjoyed making this video. If you received value from it and would like to see a lot more like it, please subscribe to my channel and hit the thumbs up button. For today's multifamily and commercial mortgage rates, tap the link below for Apartment Loan Store, where you will find 8 rate sheets that are updated daily. You will also find the guidelines for most of our loan programs. To get a free first chapter of my book, The Encyclopedia of Commercial Real Estate Advice, you could also tap the link below for that. Thanks for watching, and see you on the next episode, and be well.